In 1975, the average American home cost about 2.5 times the average household income. Today, in most major cities across the developed world, that ratio has more than tripled. Wages went up, productivity went up, building materials got cheaper to produce at scale, and construction technology improved. By almost every economic measure that should make a house cheaper to build, houses got easier to build. And yet, they got less affordable. Not a little less affordable. Structurally, permanently, mathematically less affordable. The easy answer is immigration or greedy investors or not enough houses. Those explanations aren't wrong exactly, but they're symptoms. They're the froth on top of a much deeper mechanism, one baked into how modern economies are built, financed, and taxed. And once you understand that mechanism, you stop asking, when will housing become affordable again? Because you'll see why, under the current system, it structurally can't. This is the real reason houses will never be affordable again, and it has almost nothing to do with hammers, nails, or how many houses get built. The thing that isn't like the other things. To understand this, we need to separate a house into two completely different economic products that we've been mentally bundling together our entire lives: the structure and the land. The structure, the bricks, the timber frame, the plumbing, the drywall, behaves like almost every other manufactured good in a modern economy. Over the last 50 years, construction technology, prefabrication, and materials science have all improved. If you isolate just the cost of physically building a house, it has stayed remarkably close to flat in real terms, and in some categories has even fallen. The land underneath it is a different animal entirely. Land is what economists call perfectly inelastic in supply. You cannot manufacture more of it. You cannot improve the technology of making land the way you can improve the technology of making concrete. There is a fixed amount of land within commuting distance of a job-dense city center, full stop. This distinction matters because it means a house is really two products glued together, one that gets cheaper over time, and one that, by definition, cannot expand to meet demand. And in any market where supply is fixed and demand keeps growing, price has nowhere to go but up. Not temporarily, structurally, that alone would be a problem. But it's not the whole story, because plenty of countries have plenty of land, and their housing is still unaffordable. To understand why, we need to look at what land actually is in a modern financial system. Land isn't a commodity, it's an asset class. Here's the part most explainers skip. Sometime over the last 4 decades, land near economic centers stopped behaving like a commodity and started behaving like a financial asset, closer in function to a stock or a bond than to a bag of flour. This shift happened for a specific reason: interest rates. When central banks lowered interest rates across the developed world from the early 1980s onward, and especially after 2000 AD, they didn't just make mortgages cheaper. They fundamentally repriced every long-duration asset in the economy, and land is about as long-duration as an asset gets, because it never depreciates and never runs out of usefulness. Think about how an asset gets priced when interest rates fall. The lower the rate, the more a buyer is willing to pay today for a stream of future value, rent, capital gains, or simply the utility of living there. Economists call this effect discounting, and it applies to land with brutal efficiency, because land, unlike a factory or a business, generates value indefinitely with no maintenance curve resetting its worth to zero. So, when rates fell for 40 years, the present value of every piece of urban land on Earth rose, independent of wages, independent of population growth, independent of how many houses got built. This is why, in city after city, house prices decoupled from local income growth, starting almost exactly when this rate-cutting cycle began. This is the mechanism most people never see, because it's invisible in daily life. Nobody experiences asset discounting. They just experience rent going up. The globalization of a local good. Here's where it compounds. Land is immobile. You cannot ship a plot of Vancouver soil to Ohio, but capital is now almost perfectly mobile. Money can cross borders in milliseconds, chasing the best risk-adjusted return anywhere on the planet. That creates an odd asymmetry. A fundamentally local, fixed-supply good, housing near good jobs, good schools, and good infrastructure, is now priced by a global pool of capital. A pension fund in Toronto, a family office in Singapore, and a first-time buyer in the same city are all bidding in the same market, but only one of them is trying to buy a home to live in. The others are pricing it as a yield-generating, inflation-hedged, virtually risk-free store of value, and they're not wrong to. In a world of low interest rates, volatile equities, and currency uncertainty, prime real estate is one of the best-performing, most stable asset classes in financial history. That's fantastic if you already own some. It's catastrophic if you're trying to buy your first unit of it, because you are now competing with the accumulated capital of the entire world for a strip of dirt that, by definition, cannot be replicated. This is why housing affordability is not really a local supply problem in most major cities anymore. It's a global capital allocation problem wearing a local supply costume. Why just build more houses isn't the full answer. Economists, and this channel included, generally agree that restrictive zoning is a massive contributor to unaffordability, and loosening it would meaningfully help. Cities that build abundantly, like Tokyo, have kept housing costs far more stable relative to income than cities that don't, like San Francisco or Sydney. That part of the story is true and worth taking seriously. But build more runs into a wall that zoning reform alone can't solve. Even in a world of perfectly efficient permitting, the most desirable land, the land within a short commute of the highest paying jobs, is still fixed. You can build taller, you can build denser, you can absolutely lower prices meaningfully by doing both. What you cannot do is build more proximity. The closer land gets to becoming genuinely more abundant, the more its financial scarcity value gets bid up by exactly the global capital described in Section 3 SEC, because scarcity is the entire source of its investment appeal. In other words, supply-side reform raises the ceiling on how many people can live somewhere. It does not, by itself, break the mechanism that turns land into an appreciating financial asset in the first place. The incentive nobody wants to remove. There's a final, uncomfortable piece. Existing homeowners are, collectively, the largest and most politically powerful voting bloc in most developed democracies. And they are directly financially incentivized to see land values keep rising. This isn't a conspiracy, it's simply how incentives work. A homeowner who bought at yesterday's prices benefits every single time restrictive zoning, low interest rates, or global capital inflows push land values higher. That homeowner also votes on local zoning boards, city councils, and national interest rate politics, often more reliably than renters and first-time buyers do. This creates a structural feedback loop. The people with the most political power to fix the affordability mechanism are the people who benefit most from leaving it exactly as it is. Not out of malice, out of ordinary rational self-interest, multiplied across tens of millions of households and several decades of accumulated equity. Instead, given all of this, affordable housing, as most people remember it, a house costing 2 to 3 times the median income, would require reversing several deeply entrenched forces simultaneously. Interest rates would need to rise meaningfully and stay there. Global capital flows into real estate would need serious structural friction. Zoning would need to loosen dramatically in exactly the highest demand areas, and existing homeowners would need to accept falling paper wealth without political revolt. Historically, these forces don't reverse all at once. They shift slowly, unevenly, and usually only after a genuine economic shock forces the issue, the way the 2008 crisis briefly cracked prices before the policy response reinflated them within a few years. That's the honest, unglamorous answer. Not a scandal, not a single villain, a set of financial mechanisms, entrenched incentives, and physical constraints that all point in the same direction at once, which is exactly why this isn't a housing story. It's an interest rate story, a capital market story, and a political economy story that happens to be wearing a housing story's clothes. How do you win in a system like this? If there's one thing worth taking away from this, it's that the next time someone tells you housing unaffordability will fix itself once enough homes get built, you'll know to ask the follow-up question: built for whom, financed by whose capital, and priced against what interest rate? Because until those 3 things change together, the land under your feet isn't just where your house sits. It's one of the best performing financial assets in the world, and you're not just buying a home. You're